Really comes down to when you look back at historic periods of such low volatility, they tend to be better buy signals than sell signals. In other words, there was over 100 days where you didn't have the S&P 500 down by 1% in a day. The only two times that's happened is 1985 and 1995. Those two times were predecessors to corporate tax cuts or proposals for corporate tax cuts and regulatory change. So I think the real story that I've found in the last couple of months has not been that companies and individual investors or professional investors are anticipating tax cuts or anticipating major regulatory change. They're just grateful that it's not going to get worse. They know with the Republicans in the Congress that you're not going to have increased regulation and you're not going to have increased taxes. So the animal spirits aren't about Donald Trump. Yeah. They're about that it's not going to get worse on a regulatory and tax basis.
Help me understand this, why volatility and why the VIX is still considered a leading indicator of something bad that is about to happen if it's low. When credit spreads are tight, the economic data, the volatility around that has been incredibly low as well. Earnings are stable, in fact, they're improving. So why do people look at a low VIX and decide it's a bad thing and must mean bad things are about to happen?
Because, you know, you do get spikes in the VIX. A week ago, how many people were thinking, I got to sell here because finally the VIX is picking all the way up to 14? You know, maybe it's going to finally get above 20. What I found, I just had a client meeting before I came on air, and one of the comments was that all the Wall Street firms are around telling people to get the Armageddon puts just in case that volatility does spike, and they're not doing it. They spent about 150 basis points last year from a broad buy-side perspective. They've been advised that eventually this volatility, yeah, and it is going to, but what price are you going to pay into that? So probably now is the time to do it because everybody's given up on it.
Right, and there's a distinction to be made between looking at the VIX and saying, all right, everyone's too complacent, I'm selling out, versus, look, there's going to be some short-term vol. I have to protect myself. Priya Misra of TD Securities said that the sell-off she's seen in Treasury, she's worth the 5-year. She's like, you got to hedge it now. How do you hedge that?
Hedge the 5-year or hedge the volatility?
Just hedge the short-term event risk vol.
I think it's a couple of things. And one, I think Jonathan actually framed it exactly correctly, which is that you can't look at the VIX in isolation. You have to look at the factors that drive it. Credit spreads, leading economic indicators, these are the factors that have normally determined, for lack of a better term, the fair value of the VIX. And what they're telling you now is the VIX should be low, maybe not 10, but it probably shouldn't be 20 with credit conditions as accommodative. I think, Alex, to your question, there are a couple of things you do, one of which is that as people have gotten a little bit less afraid of the Fed, a little bit less afraid of the bond market, you've seen the negative stock-bond correlation reassert itself. So it's very plain vanilla. It's not exciting, but treasuries are still providing that short-term hedge against equity market risk. The other is that if the source of that volatility is not the Fed, but it's whatever growth political scare happens to be warning investors that day, gold probably still does a reasonable job at hedging both equity risk and also credit risk.
You know, this is a really interesting thing, and I'm sure Russ would agree with me. Let's look at this last 7 years. How many times have we had a spike in volatility? Every year we have a European debt crisis. We've had a Chinese hard landing. We've had, or close to it, we've had an emerging currency crisis on weaker commodities. We've had a fiscal cliff. We've had a Brexit. We've had a Trump. We've had a Brazil. All of those were buying opportunities. There's only historically one decision you need to make as a longer-term investor. How close are we to recession? And to the point earlier, high-yield debt, is it the best level this year? Spreads are very tight. There's no signs of a credit dislocation. And the only thing that historically has made that happen is an inversion of the yield curve since 1954.
Well, there are